Welcome to OFS mentorship class. To God be the glory. We have done with the beginner sections and we are now intermediate section. Please pay close attention to this section because this is where you'll be getting your strategy from. So for today's lesson, I'll be taking you through market structure and then type of market structures and how to spot out your entry using market structure. So first of all, when we are talking about market structure is the character and the behaviors of market that enable market players to identify the possible directions of the market. Do you get that? So now we come to the type of market structures. We have three types of market structure. We have the bullish structure, which is the buyer in control, and then the bearish structure, which is the seller in control, and then we have consolidating structure. This consolidating structure is a type of structure whereby market doesn't have a specific directions. It's moving in a sideways. So let's go first with the bullish structure. Bullish structure. When we are talking about bullish structure is the type of market structure that create higher high and then higher low. What that means is that the current high is always higher than the previous high, and then the current low is always higher than the previous low. That's what it means. Can you see? Let's say high, low, then high. Can you see this high? We break out the previous high to create a new high and come back, make the previous high as a support for the new low, then take another height again and break the previous height again and break the previous high to create a new high, come back to the previous height and make it a resting point, which is the support, a resting point for another movement. This is the example of bullish market. When you see this type of structure, you know that buyers are in control of this market and you should be going with a buy. You should be going with buy and forget about sell. You should not sell, despite the fact that the market is bringing down a little bit sell. That sell will not help you. Sometimes that sell will leave you behind and go with buy because the whole structure is buying structure. So when you see a structure like this, you should be buying. Do you get that? Okay, let's go to a bearish structure. When we are talking about bearish structure, in the other hand, bearish structure is the type of market structure that create lower high and then lower low. What that means is that the current low will always be lower than the previous low, and then the current high will always be lower than the previous high. Do you get that? So this is the example of bearish structure. Let me show you the example of bearish structure. You see low, lower high, and then lower low, then lower high, and then lower low. Can you see? So when you see a structure like this, you should consider it a bearish structure. When you see a structure like this, you should be selling and not buying. Depending the time frame that you are using to identify that structure, you should be selling. Can you see? So this previous low, let me show you this. This previous low is higher than this current low. Can you see? And then this previous high is this previous high is higher than this current high. So the current high will always be lower than the previous high, and then the current low will always be lower than the previous high. Can you see? So when you see a market like this, you should consider it a bearish structure, depending the time frame that you are using, and you should be going with what? With sell. So in another hand, we come with consolidating market. We come with consolidating market. Consolidating market is a type of market structure whereby the distance between the high and the low are tend to be equal. Let me show you. This is the consolidating market. The market doesn't have a specific direction. The distance between the high and the low are tend to be equal. Can you see? Sometimes it can come halfway like this and then break down again. Sometimes Sometimes it can come this way like this and then break down again, but it will not break this height, neither will it break this low, but it will be trading within this zone. You can consider it a consolidating market. The market doesn't have a specific direction. Do you get that? So these are the three types of market structure. Now, how will you spot out your entry? Let me show you how to spot out your entry using a bullish market structure. Let me take you to the chart and explain to you better. Now, can you see with this market now we can consider this market a bullish structure. Let me show you. We can consider this market a bullish structure. Can you see a bullish structure? Because the market is creating higher high and then higher low, higher high. Let me show you. You see, the market is creating higher high and then higher low. Let me show you. Higher low, then higher high. Can you see? All this is a bullish structure, is a buying structure. Can you see? Is a buying structure. Is a buying structure. All these are buying structure because the current high tend to be higher than the previous high, and then the current low tend to be higher than the previous low. So you consider a market like this a bullish structure. Now to figure out your entry point using a bullish structure, like as I said, when the current high break when the current low, this is the current low, right? Let me show you. This is the current low. If this current low trigger another move to break this current high and create a new high here, your entry point, you first of all mark a horizontal on this previous high, because that is where the current low is coming. It's coming to make that place a resting point. So that resting point now become your entry point. You get? So this resting point, this place now become the entry point for the current low that is coming down. Do you get? Then this low again will trigger another move up here again. So when it trigger another move and broke this high to create a new high, you mark this high. Do you get? You mark this high because the next dropping is coming to make that place a resting point. That resting point now will become your entry, will become your buy entry point, and target the new high that created, and target this height as your exit point. Do you get that? So that is how to spot out your entry point using a bullish market structure. Do you get? So the same thing with bearish market structure. When you are trading on a bearish market structure, you use the same method to trade. Like now, the market drop down here and create low. This point, you should not enter from this point. Wait for the market to go up here. When the market go up, you wait, it drop down. At this point now, you should not enter. Now you are targeting this height to short the market down, because this, you are targeting this place to short the market down, because this low we come and find a resting point for this previous low. It will come and find a resting point for this previous low. So you mark a horizontal line on this previous low here. So this previous low become your resistance. It become your resting point that this height is coming to hit. It's just like you throw a ball up, there is something up there that will bounce it down. So this place now become a bouncing down, that this one will come and rest. So this resting point is your entry point. Then you short it down. Where this market left from is going to be your take profit. You mark a horizontal line on where this market left. It become your exit point or your take profit. Do you get that? So now I'll take you to a consolidating market. Now, how do you enter a consolidating or trade with a consolidating market? In a consolidating market, when you find a market like this, you should not trade inside this zone. Do not trade in a zone like this because you will definitely lose money. When you see a market like this, what you should do, wait for either a breakout in any direction. Now, if this market break out, you are not chasing this market up. You wait for the market to retrace down, just like using the Newton's law of gravity. Whatever that goes up will come down. Once it comes down here, this is your entry point, because now you have getting a resting point here. You have getting a resting point. Once you enter from this point where the market came from, mark the horizontal line here. This is going to be your take profit. Do you get that? And again, for example, if we break down in the bottom line, you use the same method. Wait for the retracement. Now, if we break down in the bottom line, wait for the retracement. For example, if we break down like this, wait for the retracement to come here and get a resting point. This resting point is your entering point. Do you get? There are a lot to consider before you enter, but I'm just using all this one for you as an example first, because sometimes you don't just enter immediately. When we begin to step up higher, I'll begin to show you some of the confluence that you will see before you enter. But these are the basic things regarding market structure that you need to know. Do you get that? So these are the basic things regarding market structure. So let me take you to one market. Let me use one market as an example. Okay, let me use British pound. Let me use British pound as an example. Yeah, I think it should show exactly what I'm talking about. Yes. Can you see? Now, this is British pound. I want to use this British pound as an example. Can you see this market? Now, this market have started creating a lower low and then lower high, because it's changing direction now. Bearish are dominating, sellers are dominating the market now. Can you see? So immediately this market dropped down here. What did it do? It pulled up here a little bit. So now you want to wait for a change of character for the market to break this current low before you find your entry. Can you see? As the market break this current low, what happened? It begin to retrace back to that same low to find a resting point before it will trigger it down again. Can you see? So this resting point should be your entry point depending the time frame that you are using. Do you get that? So this resting point is your bouncing down. So at this point, you enter your market and target this place as your first take profit. And if you are good in technical analysis and you know where the market is going, before you extend down again. But mind you that the market will still retrace back again like this. This is the mystery behind this market structure, if you understand it very well. So this is how it works. Once the seller begin to dominate, this is exactly what will be happen in the market. Pull down, retrace, pull down, retrace, pull down, retrace. Can you see? Now you will not enter on a pull down. You enter from the retracement that gives you a resting point. You always enter from the resting point. The resting point is the previous low. Is the previous low. It